Canadian General Investments dates back to the 1920s when Canada was an emerging market. It was launched originally in 1926, and then they had their own financial crisis in 1929, so there was a reorganization. The original chairman was a fellow by the name of Arthur Meighen, who had been Prime Minister of Canada, and he also invested in the company himself. And his son succeeded him as chairman, and then in 1955 started the Modern Management Company, then Meighen and Associates, now Meighen and Associates. The three original people involved with that were Max Meighen, Ali Barron, who was what you would today call the portfolio manager, and my mother, who ran the administration, and she was 20 years younger than the other two, so 45 years later, she was the last one standing and had the company. It proves you should always just stay in one place and you'll eventually rise to the top. And then she passed away in 2001, and my sister and I have been running the company ever since. And so we own the management company, and together we control just over 50% of the shares of Canadian General Investments. Well, to invest in CGI, there really is no criteria. It's a stock in the market. It's a closed-end fund, or as you say in the UK, an investment trust. So anyone can buy it. You buy it through an investment advisor, and you can buy it all through the trading day. The fund itself invests primarily in Canadian equities. We'll occasionally have a few US or European equities, but it's almost 100% Canadian. And almost 100% listed companies. We'll occasionally invest in something that's not listed if there's a prospect of it listing in sort of 6 months, within the year. The companies we invest in, being a closed-end fund, we can get into special situations, take a longer view of things, but at the same time, because we don't have to fund redemptions, but at the same time, we like to make sure we have a core number of companies there that we can always be confident we're selling. These are the high quality sort of blue chip companies that we can sell if we need to raise cash. Well, in Canada, the commodities, so the energy and materials, they make up almost 44% of the market weighting. So that has a big effect on the market as a whole, and it has had on CGI as well. To be honest, in 2008, we got caught out a little bit when a lot of the smaller mining companies, oil and gas companies, basically just went no bid when the crisis hit, and you couldn't do anything with them. That's one of the reasons why we have a little greater focus on making sure we've got some core companies there that we feel confident will trade no matter what. That said, we are a diversified fund, and so we can invest in the whole market, and we aren't index huggers. We don't have a tracking bias that we have to keep. So we have been underweight the materials, have been underweight energy, and that's probably one of the reasons why we are ahead of the market over the 52 weeks year to date, 1, 3, 5, 10, 25, 50 years. Well, we are represented in all the market segments, and like the market as a whole, as the nature of the Canadian market, financials, energy, and materials are the largest weightings. However, we are underweight financials. We're underweight materials and energy as well, although I expect we'll probably see us adding to the energy sector. It seems to be recovering a little bit. And we have been overweight some of the others. There are 70 stocks in the portfolio right now, which is about standard. We are fully invested, and the top 10 generally do make up about 30 to 35% of the portfolio. We do employ gearing in the fund. We have 2 series of preferred shares outstanding of $75 million each. And they're 10-year hard retractable straight preferred. So really, they're debt. And for a combined coupon of 3.8% over, they're staggered. So it's sort of 10 years and then 5 years. The purpose of that is if we can get a return in the portfolio of greater than 3.8%, then that is an enhanced return to our common shareholders. So the way that works out is that a 1% change in the portfolio works out to a 1.3% change to NAV. Now, it can work both up and down, but over the long term, it has worked to the benefit of our common shareholders. Canadian General Investments is an investment corporation for Canadian tax purposes, and is a little more complicated than this, but simply put, if we pass out dividends that we receive and realized capital gains to our common shareholders, we then recoup the taxes that we owe on it. It becomes a flow-through vehicle that way. So traditionally, the policy has been to pay 4 quarterly dividends. And these are just regular eligible dividends. And for many, many years, it's been 6 cents a share. And then to pay out the capital gains dividend at the end of the year. The board doesn't want to tie itself to a formal distribution policy, but the average 10-year yield has been 5% in total. Something that's new is the board announced a quarterly dividend this quarter, fourth quarter of 2013, of 8 cents. So that's a 33% increase in the quarterly dividend. And we do intend for that to go forward. And it's part of a decision to focus more on the quarterly dividends and less on the year-end payout, so that our common shareholders have a greater transparency of the sort of dividends they'll be receiving. The main message for investors is that Canadian General Investments is a one-stop shop for Canada. So if you want a Canadian allocation, and you should, then Canadian General Investments is an easy way to do it. It's a diversified Canadian portfolio that offers superior long-term growth with good capital appreciation, and with management being a major shareholder, has skin in the game, and its interests are aligned with yours.